Hi you guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. I had a viewer ask me about substantial equal periodic payments. This person was planning on leaving the workforce before 59 and a half and had heard that there was a way that he could take money out of his IRA or his 401k without paying the 10% penalty. And you guys, what we're going to talk about here, first of all, I'm not a financial advisor. I don't play one on YouTube. If this is something you're going to do, you definitely want to look into it with a tax professional so you don't mess it up. Because if you do, there's big ramifications. First of all, the easiest way is if you have a 401k active at the job you are with. If you're 55, you guys, you can take that money out. As long as it stays in that 401k, you can withdraw the money. But in his case, he doesn't have that option. So today we're going to talk about substantially equal periodic payments. And we're going to go into a little detail of the rules behind them and what they mean. So let me move myself over here out of the way. You guys, on my channel here, we talk about investing, retirement, taxes, and all things to get you well-rounded in your goals to become financially fit and financially free. So if that's something that interests you, drop me that like, hit the button and subscribe, and we'll get started. All right, so substantially equal periodic payments. What is a substantially equal periodic payment? It's a method of distributing funds from an IRA or a qualified retirement plan prior to the age of 59 and a half that avoids incurring the IRS penalties for withdrawal. Typically, an individual who removes assets from a plan will pay an early withdrawal penalty of 10% on the distributed amount. With the SEPP plan, funds are withdrawn penalty-free through specified annual distributions for a period of 5 years or until the account holder turns 59 and a half. Now, you guys, why that? Whichever comes later, income tax must still be paid, of course, on the withdrawals. So the reason that's important, you guys, if he's 55 and he's going, he'll have to them till he's 60. So that's not too bad. But if somebody, let's say, wanted to leave at 50, they would have to take them for 10 years because they would have to take them every year until they turn 59 and a half. So that's something to think about. All right, so how a SEPP plan works. And actually, I'm going to go over to a different page here because we're going to talk about 72T rules. But basically, it's the rule that allows you to do substantially equal payment plans. So it's a rule that allows penalty-free withdrawals from your IRAs or other tax-advantaged accounts like a 401k, a 403b, right? This rule allows the holders to benefit to the benefits from their retirement plan without paying the 10% penalty. So there's a couple takeaways we got to say. First of all, understanding the rule of 72T. It actually refers to the code 72T section 2 of the tax code, which specifies exceptions to the early withdrawal tax that allow IRA owners to withdraw funds from their retirement accounts before 59 and a half, as long as certain qualifications known as SEPP regulations are met. Now, you guys, this is, as I said, this is something you want to talk to a tax professional because if you mess it up, you can get in big trouble. Okay, to take advantage of this rule, the owner of the retirement account must take at least 5 substantially equal periodic payments. The amount of the payments depends on the owner's life expectancy and how it's calculated through the IRS approved methods. You must also withdraw these funds according to a specific schedule, and the IRS offers 3 different methods for calculating your specific withdrawal schedule. You must adhere to the payment schedule for 5 years or until you reach 59 and a half, whichever comes later, unless you become disabled or you die. All right, so there's 3 different ways to calculate the payments. And the 3 methods are the amortization method, the minimum distribution or life expectancy method, and the annuitization method. So with the amortization method, it determines yearly payments amount by amortizing the balance of the IRA's owner account over single or joint life expectancy. This method develops the largest and most reasonable amount an individual can remove, and the amount is fixed annually. On the amortization method, you guys, now the difference is if you are single, then you would use the single life expectancy. If you have a beneficiary who is younger than you, like let's say you're leaving it to your wife and she's younger than you, then you may have to do it on the joint life because it's going to take it based on the younger age, okay? With the minimum distribution method, it takes a dividing factor from the IRS's single or joint life expectancy. Using it to divide the retirement account's balance. This method is nearly the opposite, as the annual early withdrawal payments are likely to vary from year to year, though not substantially. The key difference between this method and the amortization method is the resulting payments with the minimum distribution method, as the name implies, are the lowest possible amounts that can be withdrawn. And finally, the third approved method is the Energization, which uses an annuity factor method provided by the IRS to determine equivalent or nearly equivalent payments in accordance with the regulation. This method offers account holders a fixed annual payout, with the amount typically falling somewhere between the other two methods. So let's do an example of how we would figure this out. So as an example, assume a 53-year-old woman who has an IRA earning 1.5% annually with a balance of $250,000. She wishes to withdraw the money early under the rule. Now remember, because she's 53, she'll have to take those until she's 60. Okay, using the amortization method, the woman would receive approximately $10,042 in yearly payments. If she used the minimum distribution method, she would only receive around $79.62. And if she used the Energization, you see it's in the middle, $9,976 would be her annual payment. So there's a couple cautions you need to know about this. First of all, withdrawing money from a retirement account is a financial last resort. That you don't want to mess it up. If you have other options, you guys, this is probably the better way. Now, if we go back in here, you'll see that there are some problems with this as well. There's some disadvantages. Okay, first of all, we talked about the fact that however early you start, you have to go until you're 59 and a half. So if you started at 40, for example, you'd be taking 20 years of required things. And here's a couple of the drawbacks. So the plan has distinct drawbacks. However, to start, they're relatively inflexible. Once you begin a SEPP plan, you must stay with it for the duration, which can potentially be decades if you start early. During that time, you have little to no leeway to alter the amount you can withdraw from the fund each year. And quitting the plan early is hardly an option, given the fact that you will have to pay all the penalties on the money, as well as paying the interest on the penalty years that you didn't pay. It is, and if we look at the amortization method, let's go into a little bit more detail here. So we said it's determined by using the life expectancy of the taxpayer or his beneficiary, and choose an interest rate of not more than 120% of the federal midterm rate. Now, the thing that's confusing about that is the federal midterm rate changes from month to month. So you have to make sure that when you do it, when you start it, it's based on your starting time. You can't just pick a time and figure it out. You have to do that and it stays. Now, you can change your method one time in this. But the IRS advises individuals to select the method that best supports his or her financial situation. You are permitted to change the method you use once within the lifetime of the plan. Should you cancel the plan before the minimum holding period expires, you will have to pay the IRS all penalties it waived on the plan's distribution plus interest. So you guys, this is really something that you want to do right. If you have other assets, if you have either Roth assets that you can take, maybe you're taking some of your contributions, or if you have taxable assets, this may be an easier way to do it, especially if you've only got to do it for 5 years, or just saving up some cash in preparation to retire. The 72T is certainly an option, but it's complicated. It's not something that I think people should try to do on their own, because I said if you mess up, the IRS doesn't care. They're going to charge you the fees and the penalties. So this is something to think about if you are planning on retiring early. Either maybe plan ahead and put some assets into a taxable account that you can draw down for that time frame, or As I said, take some of the contributions from your Roth IRA if that's an option for you. If you do decide to do that, again, find a professional that can help you with it and be very, very careful. I hope you guys got something out of this. If you did, do me a favor. Drop me that like. It really helps the algorithm. Again, I'd like to thank my viewer for asking the question. He asked that I not use his name. And, of course, if somebody asks me not to use their name, I'm not going to use their name. But I appreciated the question. It was something that I knew about, but I didn't know the exacts. When I started reading about it, I realized that it's something that's quite complicated. And it's not really a DIY thing to try to pull off on your own. Not saying that it can't be, but be careful with it. All right, you guys, if you're not already subscribed, you know the deal. Hit the red button, ring the bell. We'll see ya. Thanks.